Investing might seem out of reach if you have limited funds, but starting small can still pave the way for significant financial growth over time. How to start investing with limited funds breaks down simple and practical strategies for beginning your investment journey, even on a tight budget. From exploring low-cost options like exchange-traded funds, ETFs, and fractional shares to utilizing micro-investing apps, this guide shows that you don't need to be wealthy to build a portfolio. Discover how small, consistent investments can grow over the years and set the foundation for your financial future. Today, we will talk about how to start investing with limited funds. So before we start, make sure to hit the like button and subscribe to my channel. Understanding the power of small investments. The key to starting your investment journey with limited funds lies in understanding the power of compounding. Compounding refers to earning returns on both your initial investment and the returns generated by that investment over time. Even if you invest a modest amount, consistent contributions combined with the power of compound interest can lead to substantial growth. This concept highlights why starting early, even with a small amount, is more beneficial than waiting until you have more money to invest. For example, consider investing just $50 a month at an annual return rate of 7%. In 10 years, your investment could grow to over $8,000. While $50 a month may not seem significant, the compounding effect magnifies the impact of those consistent contributions. Therefore, it's crucial to overcome the hesitation to start investing just because your initial budget is small. Assess your financial situation. Before you start investing, it's essential to have a clear understanding of your financial situation. Assess your income, expenses, debts, and savings. The goal is to ensure you have a solid financial foundation and can afford to invest, even if it's a small amount. Here are some key steps to consider. Create a budget. A budget will help you track your spending and identify areas where you can cut back to free up funds for investing. Make sure you allocate money for essential expenses, debt repayment, an emergency fund, and your investment contributions. Build an emergency fund. Before you start investing, make sure you have an emergency fund with at least 3 to 6 months' worth of living expenses. This cushion will prevent you from having to sell your investments during a financial emergency. Pay down high-interest debt. If you have high-interest debt, such as credit card balances, it's wise to prioritize paying it down. The interest on such debt is likely higher than the returns you'd earn from investing, so paying it off first makes financial sense. Once you've stabilized your financial situation and freed up some extra cash, you're ready to dive into investing. Set clear investment goals. Having clear investment goals can guide your decisions and keep you focused on your long-term financial objectives. Start by asking yourself why you want to invest. Is it to build a retirement fund, save for a down payment on a house, or generate passive income? Your goals will influence the type of investments you choose and the strategies you employ. Short-term goals. If you're investing for a goal that's less than 5 years away, such as saving for a car or a wedding, you'll want to keep your investments relatively low risk. Options like high-yield savings accounts or short-term bond funds may be appropriate. Long-term goals. For goals like retirement or building generational wealth, you can afford to take on more risk with the potential for higher returns. This may include investing in stocks, index funds, or real estate. Choose the right investment platform. With limited funds, it's important to choose an investment platform that minimizes fees and allows for small initial investments. Fortunately, there are several modern financial tools designed to help beginners invest with minimal amounts. Micro-investing apps. Platforms like Acorns, Stash, and Robinhood have made it easier than ever to invest small amounts of money. Acorns, for example, rounds up your everyday purchases to the nearest dollar and invests the difference, while Robinhood allows you to trade stocks and ETFs with no commission fees. Brokerage accounts with no minimums. Many online brokerage firms, such as Charles Schwab, Fidelity, and Vanguard, offer accounts with no minimum balance requirement and low trading fees. This makes them accessible to investors who are just getting started. Robo-advisors. If you're not comfortable choosing individual investments, robo-advisors like Betterment and Wealthfront can be a good option. These platforms use algorithms to create and manage a diversified investment portfolio based on your financial goals and risk tolerance. You can start with as little as $100 or less. Start with low-cost investment options. When you're investing with limited funds, minimizing costs is essential. High fees can eat into your returns and significantly impact your investment growth over time. Here are some low-cost investment options to consider. Index funds and ETFs. Index funds and exchange-traded funds, ETFs, are great choices for beginners because they offer diversification and have low expense ratios. An index fund tracks a specific market index, such as the S&P 500, and spreads your investment across all the companies in that index. This reduces risk and allows you to benefit from overall market growth. Popular ETFs, like Vanguard's VTI or SPDR's SPY, are known for their low fees and reliable performance. Fractional shares. Many brokerage platforms now offer the ability to buy fractional shares of stock. This means you can invest in high-priced stocks, such as Amazon or Google, with just a few dollars. This feature allows you to diversify your portfolio, even if you're starting with a small amount. Target date funds. If you're saving for retirement, consider investing in a target date fund. These funds automatically adjust their asset allocation based on your expected retirement date, becoming more conservative as you approach that date. They provide a hands-off approach to investing and can be a good option for long-term investors. Automate your investments. Automation can be a game changer for beginner investors. By setting up automatic contributions to your investment account, you can ensure that you're consistently investing without having to think about it. Most brokerage accounts and robo-advisors allow you to automate deposits from your bank account. Understand and manage risk. Every investment carries some level of risk, and it's essential to understand your risk tolerance before diving in. Risk tolerance refers to your ability and willingness to endure fluctuations in the value of your investments. If market volatility makes you anxious, you may prefer a more conservative portfolio with a higher allocation to bonds or stable assets. Diversification. One of the best ways to manage risk is by diversifying your investments. This means spreading your money across different asset classes, such as stocks, bonds, and real estate. Diversification reduces the impact of poor performance from a single investment. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.